In this episode, we will discuss the value of making a loan, especially when that loan is funded through an infinite banking policy. And also, we'll discuss a little bit about how policy loans affect your policy and the true way you ought to think about that internally in the policy. She's Holly, and she helps people find financial freedom.
He's Nate. He makes sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. Nate, we kind of came up with this because I've been having a lot of conversations lately with clients and our previous podcast, even about money sitting, about the fear of taking a loan out from their policy and how that would affect their family should something happen to them in regards to the death benefit. And oftentimes you'll hear us say, oh, a loan is a prepayment of the death benefit, basically meaning if the loan's not repaid, it comes out of the death benefit plus the interest owed. And really trying to help individuals understand that a loan in and of itself within the policy allows you the freedom to have uninterrupted compounding, but actually generate even more money for your loved ones over the long period of time.
We're going to kind of talk about two things today. One is kind of answering that question or reviewing, what's actually happening when I pull money from the policy in a loan, and really why you shouldn't be concerned by it. And we'll expound on that to maybe answer the question that you've received. So I think we'll start there, but then we'll also discuss, as we are building this banking system up, at some point, I hope you'll have more money than you need personally. And then we'll be looking for other avenues to create value with your policy. One of the big ones that has hit true with a lot of our clients is becoming a lender, we call it entering the banking business for real. And whether that's just lending money to your family, which happens all the time, owning your kids' mortgages and car loans, things like that is pretty exciting. Or whether it's actually lending to other people that are not really family members, that you're just doing purely as an investment as well. And essentially how profitable that can be in and of itself, but then also how profitable it can be when tied to a policy. So I guess two-pronged there. We'll start with the first one, which is discussing what's going on inside the policy, when do we take a loan, and why we shouldn't be concerned. So what kind of brought this up?
What brought it up was a client was concerned really that if he borrowed $100,000 out of his policy, and he has $100,000 to be able to borrow, he's just let the money sit for a period of time, it basically would cost his wife or family, if something happened to him, $100,000 of death benefit.
Let's say his death benefit was $1 million.
Yes. So he leaves him $900,000 instead of $1 million.
And he takes a $100,000 loan, dies the next day. The death benefit that was $1 million has a $100,000 loan balance on it, so their family would get a check from the insurance company for $900,000.
Yes.
And he was saying, I'm a little concerned that they wouldn't get as much as they needed, or whatever it is.
They won't get the $1 million, and then I don't have that. They're out $100,000 just because I took this loan out. And yet, what he couldn't see is what the loan did for him and his family. And what I did is just go through some numbers with him of saying, let's say that $100,000, Nate and I were talking about this earlier, whether it was to buy 2 cars, and one for his wife and one for him maybe that they needed because their other cars were no longer viable or they needed to be replaced. If he doesn't take it out of his policy, he's got to borrow it from somewhere.
And I've been asked this question too, Holly. Plenty, as you were kind of alluding to, well, what happens if I die and I have these loan balances? Is my family going to get less? They're kind of misbilling the nickel behind the dime there, as you were alluding to. I don't care what he wants to do with the $100,000.
No, I don't either.
The worst thing I guess he could do is blow it all at the casino. But otherwise, we've got to do something with the money.
Yeah, whether it be taxes, mortgages, vacations, education, you can name whatever that $100,000 is going to do. But what Nate and I have done is actually to pull out the numbers to say, here's what happened. Let's say he did $100,000 and he actually was using it to reduce his mortgage or take over his mortgage, and he's going to pay it back to himself over 15 years. Now, most people don't understand the money actually never left his actual life insurance policy. It was a loan from the life insurance company to him. And the collateral for the loan is that death benefit. Okay, but he's still got the $100,000 growing uninterrupted.
Well, if we kind of focus too on the death benefit as well, Holly, just for a second, like let's say we did take $100,000 out and we made a down payment, a big principal payment on the house to reduce balance, or pay the whole thing off. And then he dies the next day. The question is his family actually any worse off?
And they're not.
If we hadn't done it, he would owe $100,000 more to the bank. So he may have gotten his family may have gotten the $1 million check, but they'd still have a $100,000 mortgage to pay off that they no longer have. So they would still have a net of $900,000.
And his wife would still have to, or family would still have to pay off the mortgage.
Yeah.
When you realize that whatever you did with that money, as long as you didn't go to a casino and blow it and waste it, the bottom line is you've left your family better off irregardless, because you're either going to have to pay it when you die and you didn't take the loan out. And so they're going to have to repay that debt at that point in time, or you took it out and now the debt is removed, like the mortgage on the house.
Or they could go, it could be, as we mentioned, like paying cash for cars. If we didn't pull $100,000 out to buy cars, we'd have to borrow the $100,000 from someplace else. We'd have a car loan. We die, the wife would have to pay the car loans off with. It doesn't matter whether it's making an investment with the money. We're just changing where it's at. So one of the things we wanted to clear up on this one was that, a loan, when some people have raised a concern, doesn't it reduce my death benefit? Yes, but as long as you don't just blow the money and it disappears, hopefully it's doing something. It's doing something you were already going to do anyway. So
yeah, like we said, like a car, like a mortgage, like an investment, you were using it for something. And most of the time, that something is a debt you've created somehow. Yeah. Whether it's credit cards, whether it's you have to get a car, whether it's education, it doesn't really matter what the debt is. It's still going to be owed when you die if you don't take the money out.
Yeah, if you just let all your money sit there, that's great. But you're going to have to go use another bank to do all the things that we could be doing with the policy in the first place. Regardless, what we're trying to encourage you to say is see the whole picture. Don't just say, well, doesn't it reduce my death benefit? Well, that's a pretty simple answer. I mean, it does, but it doesn't mean you have reduced your family's wealth by taking the loan. Normally, that's not the case unless you didn't just blow it, which would be unfortunate.
Yes.
And we're going to go on maybe to kind of the second pronged approach, and we will take one quick break here to hear a word from our sponsor, Living Wealth.
Have you ever wondered how to stop worrying and just make and keep more of your money? We believe in challenging the status quo. We believe in defying conventional wealth tools while maintaining traditional values. After all, most of those conventional tools only ever seem to make someone else on the inner circle rich. You can become debt-free, in control, secure, and achieve financial significance. Private family financing can be used in your life and even your business. Let us help set you free from worry. Visit livingwealth.com/freedom to receive your free copy of the Tree of Wealth. You'll learn about the tools banks themselves use and rarely speak about openly. These are the strategies used to launch Disney, JCPenney's, and countless successful families. For more than 46 years, Living Wealth has focused on treating clients with respect and honesty while helping them achieve financial freedom. Learn how to turn your hard work into significance. Visit livingwealth.com/freedom to instantly receive your free copy of the Tree of Wealth. You'll be enabled to have cash today and in the future. It's more than mere infinite banking. It's private family financing. Don't let banks and Wall Street dictate your financial future. Go to livingwealth.com/freedom to instantly receive your free copy of the Tree of Wealth. Now, back to Nate and Holly.
All right, welcome back. We're kind of entering the second part of the discussion, which is more on the lines of how a loan is actually a valuable tool, whether it's to yourself or to someone else, and it's on steroids whenever we use a policy to fund it. So
yes, it boosts the rate of return. It really actually
helps us make more money.
You make more money by actually doing the loan. And what Nate and I are going to do is take a real life example of $100,000 and just share with you what those numbers looks like for a policy. Typically, should you take $100,000 out of it, and how it actually boosts that rate of return and what it actually does for the policy if you used it in this manner.
Exactly right. So hopefully, as we mentioned at the very beginning, there comes a time when you have more than enough money to manage your own affairs. And we're looking at expanding the bank to help other people, whether that's lending money to your family, your children is kind of the low-hanging fruit. Most people attack that. And then to third-party individuals who are needing a loan, to private lending essentially, or there's nice things out there like Lending Club and other online services that you can lend money using. What I wanted to take us through is the value of making a loan and then the value that the policy can add to that. And to be honest, the numbers look the same no matter what the investment is, whether it's a loan that you're making or whether it's anything else. But we're using loans right now. So as I said, let's just pretend that we're doing a $100,000 loan to keep it easy. Maybe it's, to finance a big part of your son's or your daughter's mortgage. And we're going to lend it at $100,000. I don't care what it's for. We're going to say it's 6% for 180 months.
Which is 15 years. A
15 years.
Like mortgage.
It's like a mortgage, yeah, that you own. Could be to some random person, could be someone in your family, just numbers we threw on the page. And if we were to lend $100,000 at 6% over 180 months, the total amount of payments that would be paid back to you would be $151,000 ballpark.
Yep.
So that means you're getting back the 100 that you had, plus you made a $51,000 profit.
Yep.
Not bad.
Not bad at all.
Especially, if you've got collateral, which we would never suggest someone lend money without collateral, typically. That means that we were able to make 50 grand with very little risk, because if they didn't pay, we get the house. So,
yeah.
Not a bad gig. But let's say that you were practicing what we're preaching. And instead of just making a $100,000 loan in cash that you built up that's extra, you decide to make the $100,000 loan from your cash values in your policy. And so we pull out a loan of $100,000. We make this investment, this loan to someone else. They're paying us back the same payment, 6%, and both sides. The only difference is we're going to roll that entire payment back to the policy, as opposed to just letting it, send a bank account or something like that. And at the end of that time frame, we would have at minimum $194,000 in cash value. So same investment, same loan, same payments being made back. The only difference is where the money was funded and then where it went afterwards. So we made 194. That's 94,000 of profit as opposed to 51,000 on the same thing, just by changing how we funded it. Not that bad.
Not that bad. It's a pretty good rate of return for an investment. If you could give 100,000 and you earn 94, I think you above and beyond the 100. Like,
about
I think
doubled
you
it.
did. You almost doubled it.
Risk.
I think that's a pretty good rate of return. But that's the value of that loan. And if you hadn't made that loan, all you've got is still the $100,000.
Exactly right. And, we've heard Ray, who we've had on the podcast, the founder of Living Wealth. He's probably taken this to the next level. His lending business. There's no one who's built anything as far as lending goes in our client base. And I would wager in the entire country who's an infinite banker who has built up a bigger lending business than Ray. And he's been asked that before, or talked about that. His loans are probably, I'm going to say close to $5 million. I don't know what they are. I'd have to ask him. It's just kind of a ballpark.
Well, I think you're pretty close, Steve.
It might be,
pretty close.
You might know
around that number.
As far as, and he's got a company that lends money. He owns my mortgage for one.
He owns my mortgage as well. So he owns several mortgages. He does vehicles, anything that's a good loan, X-ray machines.
Done quite a few. I mean, and he's gotten pretty good at it. But he's been asked that question too, like, okay, if you die having a $5 million loans and they haven't been repaid, doesn't that mean your wife is going to get $5 million less in the death benefit? And that's what we're trying to refer everyone to, is the fact that the insurance company may send $5 million less because of the loans, but that doesn't expire the fact that there's $5 million of loans that are still going to be repaid. They're not repaying the life insurance company or life insurance. They're repaying Ray or his company, is, his lending institution. And those loans don't disappear. So the fact that she's going to get, I think she said about 8 to 9 million or something like that. Yeah. That's with the loan on the $5 million of loans that are out. Over the next 10 years, it's about 8 to 9 million that's going to come back in all those payments. So what we're trying to say is the lending business is good. If he survives through the entire time, which we all hope he does, the cash values, that's if today.
So astronomical.
That's today. $5 million loan, 8 to 9 million come back in. But if we go 10 years out, the cash values is not $8 to $9 million. The cash values are more like 12 to 13 million on that because of the extra growth inside the policies. But all that to be said, it's not that he's reduced the family's wealth. He's just moved it, as we mentioned in the last podcast, keeping money in motion. That he's moved it from the policy. It's working elsewhere. It's rolling back into the policy. But even if he was to pass away, it's not like the money disappears.
And it creates monthly income every month. My mom doesn't have to go out and get a job, really. I mean, it's literally creating income for her. And it far outlives the $5 million it cost her upon death, because she will have so much more and the family will have so much more.
Yeah.
And I think that's where people miss out. We stop that process of thinking of, oh, this number as a death benefit versus what can that money do for you and your family, not just today, but in the future.
Yeah. If we get our hands on it and move it, hopefully we're doing it well. So loans are valuable. They're a valuable tool. They're especially profitable once we add in the steroid of the policy and can utilize that. And then you don't have to be afraid of a death benefit being reduced, because we're creating value with the policy loan. We're moving it. We're doing something with it that is going to better your life. And that is, hopefully, with what we do with it, it'll be even more valuable than just letting it sit in the policy. That's the whole goal.
Yeah, and the goal too is by doing those loans, if you graduate from this earth, you typically have left your family off better than when you started, because you haven't left them all the debt. If it's debt that you yourself personally owe, whether you leave them $1 million of death benefit or $500,000 of death benefit, if you use that money to pay off debt, it basically just
washes out.
Washes out. I mean, yeah, it's like you've left her better off, or your family better off, because they would have had to use that money then upon your death to pay off the debt.
I mean, we're not. Yeah. It's not like when you take a loan out, you're losing out on something, or your family would if you were to die.
In fact, you're gaining. And I think that's the part of the concept we don't understand is, just like a loan is an asset to a bank, you have to start viewing your policy loans as an asset to you and your family.
Yeah.
And that it doesn't actually hinder your family and hurt them. You've actually made it better for your family. And chances are you're going to live. That's just how it is. They wouldn't sell you a policy if they thought you're going to die, in all honesty. So as long as you're going to continue to live, you're going to continue to generate wealth for your family today and for years to come, just by being able to understand that loan is so valuable to loan out, because the money's going to go to somebody. It's either going to go to you, or it's going to go to a bank or another lender.
I mean, that's what we're trying to help you see. And I hope this podcast was beneficial to you.
This has been another episode of Dollars and Nonsense. If you follow the herd, you will be slaughtered. For free transcripts and resources from episode number 62, visit livingwealth.com/E62.